a very warm welcome to everyone. So, this is our second episode on Money Maestro series by Team BREINTO. Through this series, we want to spread financial literacy and awareness. और इस पे बात करने के लिए हमारे साथ जुड़े हैं लोकेश और मेरे co-host आशीष और रचित. हेलो लोकेश, थैंक यू फॉर जॉइनिंग विद अस टुडे. सो लोकेश जो हमारे साथ अभी जुड़े हैं वो भी एक लीडिंग इक्विटी रिसर्च फर्म में एज अ वाइस प्रेसिडेंट काम कर रहे हैं और उनके पास 17 साल की इंडस्ट्री एक्सपीरियंस है जहां पे उन्होंने अलग अलग रोल्स में काम किए हैं लाइक इन्वेस्टर रिलेशन, इक्विटी रिसर्च एनालिस्ट, हेज फंड सिक्योरिटीज ऑपरेशंस. और इन्हीं एक्सपीरियंस के थ्रू हम जानना चाहेंगे कि एज अ रिटेल इन्वेस्टर उनके लिए कहाँ कहाँ पे अपॉर्चुनिटीज है इन्वेस्ट करने के लिए. तो चलिए हम अपना डिस्कशन शुरू करते हैं. और लोकेश, आपसे मेरा पहला सवाल है कि एक रिटेल इन्वेस्टर के लिए अपने करियर में सबसे जल्दी शुरू करना इन्वेस्टिंग कितना जरूरी होता है?
Thank you, Hers. So, what I believe is that in share market or in any kind of investment, two two things are very much important. First one is time. Second one is diversification. First, I will take the time. So, early start is always beneficial for you in all kind of investment, whether it is gold, real estate, whether it is share market, fixed deposit, anything you take. If you give it a good time, the investment return would be far better compared to a short-term return. The reason being, the share market is prone to many external factors which are global as well as local. So these factors will affect your performance in both positive way and negative way. So let me give you an example. In last, say, 6-7 months, the market return has been phenomenal. The Sensex has reached 250,000 level from its lows in March and first week of April when it was around 25,000. So it is close to 100% return for the index. Before that, if you see, the return was somewhere in negative. So if someone had invested previously for 1 month, the return would have been huge negative. If someone had invested in last 7-8 months, the return would have been far better. But when you invest in a long period of time for say 5 year, 10 year, the impact of these positive and negative factors smoothen, and what you get is a return which is not impacted by this time factor or the global economic factors. Let me give you an example here. So there were two friends, A and B. I am taking an example. So A started investing say 5,000 rupees per month, and he invested for 4 years. The return on his investment was 1% per month, that is 12% per annum. He started investing after 5 years, and A stopped investing just after 4 years. After 15 years, the value of the investment of both the people was both A and B was same, almost same, I would say. So the advantage A had, it started investing 5 years before B started investing, and just to reach, because of this 5 year delay, B had to invest for 10 years, and while A invested only for 4 years. So the investment amount for A was 2,45,000, while his return was around 11,70,000, while B invested 6 lakh rupees plus, and his return was around 11,67,000. So this is the power of compounding. This is the power of time, which is very important in investment. whenever you see a return of mutual funds like 3 month return, 6 month, 1 year, 2 year, 5 year, 10 year, you would see that most of the schemes have done well in a longer time of horizon, like 10 year, 5 year, you would see positive returns.
Right.
But when you see investment return for 3 years, 3 month or 6 month, it may be huge negative, or there may be a huge differences between the schemes of
Correct.
same fund.
Okay.
So,
Correct.
so that's why I would say a long-term investment is very, very important, essential in share market.
Right.
Very well. Yeah.
So very well said. So just taking your example, if somebody would have invested last year in January, he would have been in great negative by June, and by this year January again he is in green. So we have to uh, remove the short term hiccups. We have to just look for the long term. Very rightly said, Lokesh.
So, Lokesh, I think that really motivates me to invest early, although I am the person B here right now, who hasn't started investing early. But surely I will make sure that starting next month, I'll invest at least 500 or 1000 rupees at least to start with, right? But that brings me to the next problem that I have, right? So, and that's a pretty common one. I would say that should I, in as a retail investor, approach a stock market via myself, applying my own knowledge, which is very less right now, or go to some experts, right, like the financial advisors that we see, right? So, what would you recommend to a person who's just starting to invest?
Yeah. So let me take it that way. So investing in share market is not a part-time work. It is neither a hobby. So it requires a lot of time. It
Mhm.
takes your space of your brain. It takes away peace of mind, your sound sleep. So if you are ready to give up all those things, you can approach the market directly. So like you may be getting stock tips from your distant relative or friend of friend, but that is not called investing. That is speculations. When you invest, you have to do your thorough research. You have to that's a scientific approach to it. You need to analyze your risk taking capability, your willingness to take risk. Then you need to select the asset class. You need, as per your risk profile, then choose the assets in that particular asset class. Then you need to monitor the performance of your portfolio, rebalance the portfolio as per change in risk profile. All this requires time and your effort, as well as you also need to have expertise to do this. So resources and expertise both are needed for this work. If you have both, if you can devote your time, if you have expertise to do all this, you can approach the market directly. The other thing is, see, most of us are doing some job, maybe private sector job. We may be involved in a profession, or we may be doing some business. That is our main source of earning. We earn money from that job, business, or profession, and that money is invested in the other asset classes. One of them is stock market. So if you make your investment in share market as your main job, or if you start investing directly, your
Mhm.
other work, your main work, where you are earning money, that will get affected. And I'm telling you with 17 years of experience that you cannot remain immune to ups and down of market. It will definitely impact your peace of mind. It will definitely impact your other main work. So that is the hazard when you invest directly into the share market. So the point here is, if you have expertise and if you have time, then you can go directly. Otherwise, the best route would be to go through the experts.
With this, I have a question that let's say if I have decided that I'll invest on my own, and I'll not take the route of mutual fund or some other expert. So there are so many tips given on social media platform like YouTube, Twitter, and all. So how do you ignore those noises and find out the right piece of advice?
Honestly speaking, it is not an easy task because you would find advice pouring from all sides. You may get tips, advice from your friends, and they would not give you those advice with some wrong intention. Uh, your relatives may tell you something which they might have heard from someone else.
Right.
Newspapers are filled with these stock tips. Social media has this information flowing all over the. There are brokers which are publishing their reports. There are market related website, business channels like G Business and this CNBC and all. You would find Anchor all the time giving you stock tips only. So, so you would, if you start acting on advice of those people, you would go mad, I would say. So, in many of the cases or most of the cases, these advice are freely available. So when you get a stock tips freely, it should click in your mind. It should create curiosity in your mind that why someone is doing research for me, putting efforts to find good stocks, and giving those tips to me free of cost. There must be some vested interest. So in our profession, we call this uh, front running. So front running is like say I want to give you a stock tip, say buy XYZ company stock. Before giving that advice to all over the world, I would buy the stock of XYZ at low value
Mhm.
and then would start giving that tip that buy XYZ at all the places on TV, on website, on news channel. You may receive messages on your phone that this stock is going to do well going forward and buy this stock. So uh, uh, some people would act on that advice because if they hear from all the places and stock would move up. When stock has moved up, I would dump that stock. I will sell that in market and will exit from that stock. And those who have invested considering that it will go up may end up losing the money. They may not find a buyer because of low liquidity in that stock, or the stock price might have fallen below the below your buying level. So this kind of situation has happened in the past. Recently, a advisor on a news website, the business news channel website, was fined by SEBI for this front running on stock tips. So he used to give those advice to investors on TV, and before giving that advice, he used to act on those tips. So so it is very difficult because you see this kind of advice all over. So I would say that uh, how to find good expert is it it is not freely available. First thing is, so if you have got a paid research, you may rely on it. Uh, the other source of information which is not publicly available, I would say, but yes, if you put effort, you may find. So there are some renowned research houses, institutional brokers. They publish their research report on stocks. So if you get those reports, you can apply your brain. You can take you from those reports and can start your own research from on those stocks. So this is the way you can act on good expert advice. You should apply your own brain. That is most important.
Yeah, I
Okay.
think it's a very relevant point. I think given the kind of social media platform we have exploded, like YouTube, Instagram, and so many new apps coming up, and we kind of subscribe to each and every of these and try to take tips out of those, right? I think you made a very valid point that no one gives a good advice for free, right? I think what I can draw out from this conversation is like suno sabki karo apni, like just do your research first and then advise, right?
Yeah, very rightly said.
Got it. Yeah, I think that's a very fair point. Moving on, I think as I mentioned earlier, right? So someone who like me who has come very late to the share market, right, and who's looking for a quick money would obviously look for a multi-bagger share, right? Right. My first idea is like, hey, मुझे जल्दी से अमीर बनना है, right? So how can I actually like? Is it advised to run after a multi-bagger share? How can I find a multi-bagger share? And even if I take that share in my portfolio, how difficult it is to retain in my portfolio?
Okay, so your question is again based on the two questions which you asked me before, like how should I approach to the market or the early start of investing. Like if you have got multi-bagger stock which has turned 3x, 4x in a very short period of time, then here there may be some front running going on that stock. That is possible.
Mm-hmm.
The other point is here the let me give you the other story of this case. So there are some cognitive bias which are studied in behavioral finance. Uh, One of them is loss aversion. So which means that if you lose $1, it will cause you more pain in terms of absolute value. Then you gain 1 rupee and that gives you a joy. So you would avoid losing 1 rupee rather than earning 1 rupee. So so what happens when you have made some profit in a stock, say 10%, 20%, maybe 50%, you would find it very difficult to hold that stock because there would be a fear of losing that gain. So you would try to exit
Right.
or you would try to book that profit. So here, what you should do, you should there's a renowned stockbrokers ad on the TV I have seen, and there's a tagline that buy right, sit tight. So first, you should buy stocks which are fundamentally strong, which have strong governance. Means there should not be any issue related to the promoter side or some corporate governance issue should not be there in those companies. Otherwise, 1,000 rupees a stock or more than that, like Yes Bank, which used to trade very high valuation at some point of time, was trading below 10 rupees at some point of time. So that is because of corporate governance. So if you have bought something which has sound corporate governance policies in place where promoters are professional, the company is being run professionally, and you have got good return, then you should not be worried about that, and you can sit tight with that case. So here, investors should do thorough research before investing, and once you have made investment, you should decide a time horizon that I will invest in this particular company for 2 years, 3 years, or 5 years, and post that only I will exit. Then you may avoid this kind of situation where you are unable to make good gains, but you are exiting before taking advantage of the movement in a stock. So that is
Okay.
what I say, do thorough research and invest for a long term.
Yeah.
All right.
Good.
Yeah.
Okay. So I have a question here. So generally, there is a belief that if high risk leads to high return. Now, if we apply the same thing in stock market, generally people invest in small cap in a hope that they will get good returns in some year or maybe in some time. What is your opinion on this? Does it really happen that a high risk leads to high reward?
See, let me ask you one question. See, if I have a coin and I spin that coin, I have a probability of getting the head and tail. 50% probability of both. But if I do that 10 times, I may not get head 5 times, or opposite of that, vice versa. But if I do that for say 10,000 times, 50,000 times, the ratio of head and tail may be 50-50. So the case here is, if you buy, say, the risk profile of mid cap, small cap, they have high betas, means they would move faster than the broader market. It may be, it would be applicable on both sides, the downside and upside. So uh, if you have bought, say, there are thousands of a mid cap and a small cap, there are around 5,000 companies listed on BSE, and companies below 500, top 500 are called, and even see top 100 are called large cap, 200 to 250 called mid cap, and below that it is called a small cap. So there are thousands of small cap stocks. So you can buy 5, 10, very small number. So those 5, 10 may not represent the risk profile of the small cap which has. So in that scenario, I would say it is a good idea to invest in a small cap or mid cap fund, or a small cap mid cap index, where you get advantage of movement of entire constituent of those index, or those that fund. So in that case, you have diversified your investment among a large set of small cap and mid cap companies. If you have chosen, say, 5 or 10 mid cap, small cap companies, there may be corporate governance issue, which are highly prevalent in the mid cap, small cap companies, because they are not widely tracked by institutional investors and brokers. There may be a promoter level issue in these kind of small cap companies. But when you diversify your investment to mutual fund, that is that fund which invests primarily in mid cap, small cap, or when you invest in a mid cap, small cap index, then you have diversified your portfolio among the high beta stocks. In that case, you may get a better return. But buying 2, 3, or say very small number of stock, putting your entire money in those stocks, and assuming that you will get huge, you have taken high risk, so you will get high return. That may not be possible. You may lose your entire money. So that is my understanding with the high risk, high return related to the fund.
It's a good advice that rather than investing in specific stocks which might fall a lot, so it's better you go for index funds and reduce the risk over there. Okay,
Yes.
so I have one more question. So at this point, which sector do you think is most promising for the next 3 to 5 years?
Okay. See, in current scenario, things are changing very fast. It is difficult to forecast for next say 3 to 5 years. See, sectors which are doing good right now, like pharma and IT, these sectors were not doing so good, say 2, 3 years back. And you cannot say whether the sector will do well going forward also, say after 3 or 5 years. So it is difficult to say what would happen, say after 5 years. But this is an era of technology. Here, old economy is struggling very hard to compete with new technology companies, new economy companies. If you see the market cap of Tesla, which is a new a new technology company, I would say. It was established in 2003, so around 17 years old company. It has a market cap which is almost equal to combined market cap of all the global auto companies. So, so I believe that in next 3 to 5 years, the new technology companies will do far better than the old economy companies. So some few of them are like engineering R&D companies, companies which are involved in electric vehicle, connected vehicle. These companies see a lot of traction. Companies which are involved in infrastructure development for electric vehicles, charging station, battery. These should see good traction and good revenue in coming future. I cannot say whether it will happen in just after 3 years or 4 years, but yes, going forward in future, these companies have a good future, I believe.
Okay, that's great. Yeah, so good pointers for us to start finding out the stocks in this sector.
Thank you so much for your, first of all, time and effort of and clarifying each of the questions with proper answer and justification, which would be definitely helpful for the retail investor like us, and it will help them in their financial journey. So thank you so much, Lokesh.
Thank you.
Thank you, everybody. Thank you,
And
Hers.